Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping on every order, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 40,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend out of Denver, Dave Kranzler. Dave, it's great to have you back in the show.
Great to be here again. I love doing this show with you guys. Thanks for having me.
Well, we loved having you, and we love gold and silver prices here this week as both metals continued their rallies after the latest Fed rate hike. Gold traded as high as, I think, $12.61 earlier in the week ahead of options expiration, and it's hung in there remarkably well for options expiration. Actually, overnight, Thursday into Friday is probably the weakest of the week. Gold traded down around towards $12.38, but is back above $12.50 as we speak here late in Globex trading here on Friday afternoon. And silver has had a great week as well, trading up around $18.30. So what's your take here of the metals as they continue to move higher? Gold testing its 200-day right around $12.60 here this week. Dave, do you think it's going to be 3 taps and out for gold, or do you think this next time we'll do it?
That's a really good question. I was looking at some charts last night versus the moving averages, and clearly there's nothing magic about the moving averages other than, they become a self-fulfilling prophecy because all of the day traders and the technical hedge funds are kind of programmed the same way, So we've had a huge washout in the paper open interest in Comex gold this week. And, in terms of the ability of the bullion banks to get the technical hedge funds to do what they want them to do, that ability's been diminished because of the rapid decline in Comex gold open interest. So I just wanted to circle back because you said we're happy about the movement in gold this week. I'm actually kind of bummed out because I'm trying to buy some more silver and gold right now. So we should the prices stay down for a little bit longer. But if it goes up, the position I do have will be happy. So it does feel like, in addition to the technical condition of the market right now, it does feel like the fundamentals are lending some extra support to the precious metals and the reason to buy precious metals, and we can get into that a little bit later.
You touched on what I think is probably the most interesting artifact in this whole week's trading sequence, and that's that we've seen this gigantic, and by memory alone, I need to look this up, but I think this is the largest percentage decline in a singular week of Comex gold open interest that we've ever seen. And importantly, this was actually occurring right into and through and after the contract settlement on Tuesday this week, which is behavior that is very different than what we've typically seen what the managers of the fiat paradigm do, the gold cartel and their efforts to push gold below critical prices such that they can cover their shorts going into options expiration without having, big losses and being able to get dry powder to repeat the cycle over again because, in fact, they did not have big losses. I mean, when you're managing a big trading book, you're able to see where positions are, and that kind of positioning and trading over the course of a month is something that these gold cartel miscreants are able to do with relative ease. But all of a sudden this week, we've seen something different. And that's pretty telling. It's a strong indication that there's shifts going on within the market. And prior to our flipping on the recording, Dave and all of us were speculating about, what's going on, what's causing this. And part of it seems to be that there's just a heck of a lot more strength in physical demand versus these, paper machinations that have been able to keep bullion down for many, many, many years. I mean, gold open interest nearly was as high as 500,000 contracts. And just this week, we've seen a reduction of something like 30,000, give or take. I don't have all the numbers in front of me, but it's been a pretty significant decline. I know that we had over 40,000 decline, roughly about 10%, in just 2 days earlier this week, according to what I was looking at with, Bill Murphy's newsletter.
Yeah, no, I think the decline's been even more dramatic than that. I think it's been closer to about 60,000. We had another 14,000 decline yesterday, so
that's right.
The open interest is 414, and I don't remember where it started the week. I want to say it was around 460 or 470.
And this is very unusual behavior.
This is a massive decline in open interest, and like I said, we were discussing earlier. Typically I don't expect the cartel to implement one of their I call them hot liquidation, open interest liquidation operations, and I usually don't expect to see that until the open interest gets well over 500,000. And as Bill Murphy pointed out in his Midas report last night, for some reason they seem to have put that in motion earlier than when they normally do, meaning with the open interest well below 500,000 contracts. And you got to wonder why. You could smell desperation in that. It's kind of like, why are they so anxious to get their shorts covered here? Well ahead of when they normally do.
Yeah, and to do it before options expiration, partially too. Yeah, well, we also... Oh, go ahead.
I was just going to say, I think part of it may be related to the dollar and the yen, and they can see that the dollar's headed for some major weakness here, and they're not going to be able to keep gold suppressed under 1250 if the dollar heads back towards 95 and the dollar-yen pair heads back towards 100. I mean, you're talking, if that happens again, just based on the value of the yen and the correlation we've seen, you're talking about a retest of 1380, and then all of a sudden, all of the chart readers and the technical analysts of the world are going to see that, and it's going to be pretty clear that gold has bottomed from a long-term perspective. And if you zoom out on a 10-year chart of gold and you see gold take out last year's highs at 1380, there's not too much resistance up until about 1600, and then you're looking at new all-time highs. So not that that's going to happen tomorrow, and let's not get ahead of ourselves there, but perhaps that might be what the cartel's looking at.
That's a good point about the dollar, and it's not just the dollar-yen. I mean, I made a mental note of it earlier this week, but I didn't really think about it, and that is, I guess the Trump administration is kind of verbally lashing out at what they're calling currency manipulators now. And I think we're kind of directly referring to China. And to me, when I hear talk like that, it means the administration that's in power here wants a lower dollar. And I think that writing's been on the wall ever since Trump got elected, because he's saying he's going to revive U.S. manufacturing and put in import tariffs, and he's not going to be able to do all that, but he can at least attempt to do it, and the best way to do it is just pushing the dollar lower, right?
Yeah, and we had talked about that on a show with you, I guess, 2 shows ago. I think it was in January. I forget, forgive me. Maybe it was mid or early February when that Wall Street Journal article came out and Trump was outright calling for a lower dollar, and the markets had this big, big shift. And I should pull up a chart and have the exact date, but in any event.
Right, and then we had a big rally in the dollar, and everyone forgot about that because Hopi took over again, as it's been seemingly doing since the election.
Yeah, we were, going through kind of like thematic waves where, different brackets of time, we have different market shifts and sentiment. Like, for example, when that whole lead up to Trump speaking before Congress talking about his economic plan, and then the shifts that we saw in the dollar and the precious metals at that time, too. And I want to circle back a bit about, the yen versus dollar trade, and that's really, really important, Doc. I think that you're zooming on something that, in fact, probably is a longer or intermediate term, at least, factor in terms of what are making the cartel and other traders stand up and take notice, because the yen-dollar cross has been an artifact of part of the manipulation, and as well money flows as well. Just the FX market being as large as it is, nearly $6 trillion daily trading notional value and all of that. It's a whale. It moves markets. And that shift is happening. And then we also have China basically being behind the eight ball. They're stuck. And they're going to have to devalue their currency, because there's really no other way that they can deal with the capital flight problem that they have, and their economy being as strapped as it is with gigantic overcapacity and their credit markets suffering. I mean, China wants to have more open capital markets. They want to have a more open and world-facing market in their financial markets, and the only way to do that is to further liberalize their currency, because you just simply cannot have an open capital market without a lot more open financial transparency and open facing towards the rest of the world's capital markets. So that pretty much guarantees that in the longer term they have to devalue, given what's going on, and that's going to be amazingly bullish for precious metals. And it is why we've seen, maybe half of, or far more actually, of the gold demand that's been significant in this year in terms of large orders, certainly. I mean, that even was showing up in November and December when we had, the Swiss refineries sending 150 some odd metric tons to China, and on and on. The physical demand right now continues to be a lot stronger than what the market is, or the mainstream media's reportage and the Wall Street community's coverage of what's going on suggests. And that fits in with this really weird Comex action that we saw this week, too, I think. Remains to be seen how all these pieces of the puzzle fit together, but I think that we're going to start seeing, more strength within the bullion market, and that April is probably going to surprise people. We've even seen shares, as they have been leaned on, refuse to buckle much below where they had been pushed before. I mean, talk about moving averages and whatnot. It looked like an effort to paint the tape earlier this week and through last week to make it look like the Huey and other indices were going to break down, and they're refusing to break down, even though the technical signals would, have an average technical trader get pretty darn nervous.
Are you suggesting they would manipulate the markets, Eric?
I mean, when you pull up the Huey, and I should get the exact date here, so give me a second, but, earlier this week, we saw that hit really hard, and it was brushing up against the 50-day, and I believe it was on Monday, but I'm pulling it up just to make sure. That kind of trading action, they were trying to paint the tape to make it look like a reversal of the March 15th leap up higher in a Huey. And then on the 28th of this week, we saw it smack down. That, to me, is another example of how they've been leaning on miners to try to paint the tape.
Yeah, I agree with that. And that happened earlier this week when it was announced that Goldcorp was buying Exeter Resources on a stock-for-stock deal, and Goldcorp, they're issuing stock. And for whatever reason, the market hates it when mining stocks issue stock. Any other company, if Amazon or Tesla came out and announced a stock deal, the stock would go up 50 points. But when mining companies announce stock deals, they slam them. And Goldcorp was down, I think, close to 8% that day.
And the Huey only has, 15 stocks in it, if I remember correctly?
Yeah.
If you look at something like GDX, where there's 50-some-odd companies or whatever, it's been a while since I looked under the hood. But, the same pattern.
That, yeah.
We've been, since March 16th, we've been ramming on GDX the 50-day moving average. And the damn cartel's been leaning on miners, and it wasn't able to get over the 50-day other than, little spikes here and there here and there on an intraday basis, and then we had that March 28th smackdown. And, it was an attempt to repaint the tape in a downward trend. And it failed as of today. And gold and silver were stronger. Bullion was stronger all the while, in my opinion. And, don't have the data to back up all of this. This is just more of an educated guess, having watched these markets for, 15, 20 years, is that we have different pools of investors and speculators and electronic traders that participate in these markets. And sometimes there are shifts and in terms of like which market is more active than not, when the stackers, for example, are active buying physical versus the longer term bigger money pockets and physical versus the miners and who buys miners and whatnot. And there are times when the cartel does lean on miners in an attempt to target sentiment so as to impact other pools of actors with financial market participants. And I think that we've seen that theme going on for the better part of a month and a half now in miners periodically. And this week it looks like that's beginning to break down again too, so that, if we finally get bullion catching more of a bid, which is what this trading action combined with what we're seeing in Comex suggests, because bullion has been stronger this week than what we see with miners. Miners stabilizing and the cartel unable to knock it much into a downward trend. Who knows? I would look for next week if we see, certainly within the next 2 weeks, bullion picking up and miners finally confirming it. That would be a sign that I'd suggest to our audience is something to look for that would give a better character to the longer-term trend and the intermediate-term trend. But I think in this summer, we're going to see, or rather this quarter actually, leading into the summer and through the summer, bullion moving higher. And part of that also is related to how I see the general equities market. I think we're about to roll over. And love to talk to you about that, Dave. You have a really wonderful newsletter, the Short Sellers Journal. People should check that out. And you follow standard equities as well, and a confluence between standard equities and precious metals. And love to get your take on where you think the stock market's going and how that fits into precious metals action these days.
It's anyone's guess where the stock market's going, because it's hard to say to what extent, the Fed is in there keeping it propped up. I mean, it looked like this morning, for instance, that we were going to have a healthy sell-off today, and they after the opening drop in the cash markets, the S&P went green for a bit. So, if you look at the dislocation between the actual fundamentals and the direction of the stock market, we're probably as dislocated as we've ever been. And in my Short Sellers Journal that I'm preparing for release Sunday, I kind of break down the difference between, and Zero Hedge does it a lot, between hard data and soft data, but I break it down even more, and I've got some other goodies in there. Corporate earnings have been declining since 2013. And Wolf Richter had an article out talking about it, and I kind of drilled down into that a little bit also. But the last two times that corporate earnings declined while the stock market was screaming higher were in 1999 and 2007. So there's a lot of parallels in various metrics between now and the same metrics in relationship to the stock market in 2007 and 1999. So, it's not a question of if we're going to have an accident in the stock market. It's just a question of when. And, if the Fed could hold up the stock market forever, we'd never have stock market sell-offs, right? Mm-hmm. The other thing that's interesting, and we kind of chatted about it before we started this podcast, was the pension problem. And I think that's part of the reason why the Federal Reserve is doing its best to hold up the stock market, because if we have a 10% decline in the S&P for a sustainable period, meaning 3 or 4 months, most of these pension funds out here, the public pension funds, are going to blow up. and I have a buddy who works at a pension fund who did an internal study for his group, and he came to that conclusion. He said, first of all, these pension funds are way more underfunded than is being publicly admitted to or written about, and B, they're all wiped out if we have a 10% decline in the S&P for more than a short period of time. The last two declines we had, which were August 2015 and January 2016, those were very, very brief. I mean, the S&P basically had a V recovery.
Yeah.
And the market was down 10% for less than a month. And I think it just reflects the desperation that the central planners have to keep the stock market up, because all these pension funds, in order to try and create performance, because fixed income, which is typically about 60% of a pension fund's allocation, I mean, fixed income's returning nothing. And so my buddy was telling me just about every pension fund he's looked at is maxed out in terms of the amount of equity their board allows them to buy. And they all have negative cash outflows. In other words, the difference between the cash flowing in versus the cash paid out to beneficiaries is negative. And so every month they have to sell assets in order to make payouts. And that's a big part of what leads to the underfunding. And if the stock market goes down, they're not going to be able to make payouts very long.
And the interesting thing about those previous downdrafts were that they, in the earlier period of time, now that we are longer in the tooth and people are recognizing the market is being extended for what it is, I mean, we're nearly at 100 consecutive, months of an economic recovery. I mean, that's unheard of in the United States. And it's artificial all the while. And the catalysts that caused those 10 plus some odd percent declines in the S&P 500 were of a nature that were actually easier to reverse because, for example, when China rapidly devalued its currency in the FX market, triggered all kinds of things in the credit market, spilling over to the stock market. That's the kind of stuff that the Federal Reserve and other central banks can easily address. Plunge protection team, et cetera. It's more of like a one-off. Whereas when you talk about a shift in terms of underlying psychology about the health of a market overall and reflecting on the downturn in, the retail sector and extended nature of over-levered governments and financial actors and corporate profits declining and all of these considerations marrying up with understanding that, the political kumbaya fest that people were expecting the Trump administration to usher in with trillion-plus dollar infrastructure spends, giant regulatory swath reductions in various departments and executive branches and tax cuts and the budget. I mean, all of this stuff that people were really enthusiastic about, starting with, Trump's election and the stock market roaring higher, are now giving people pause. It's a general psychological shift of far greater magnitude that we're looking at, as opposed to some kind of catalyst that comes out of China where they devalue their currency really quickly and change the way markets are trading as a result. So, I still think that we're going to roll over in the stock market this quarter, and Fed will probably catch it. They'll probably raise interest rates in June. And then by the end of this year, they're probably going to be scrambling to try to reverse course again, because they're always led around by the nose. The Fed is a reactive organization. They don't do anything other than what the market pushes them to do. But it looks like the stock market, frankly, is long in the tooth. And then we have the credit market backing up, too. I don't know how we get out of this year without some kind of a major start of the next financial crisis rolling into next year. It's just too long in the tooth.
Second that.
The manipulation has gone on too long. These economic policy masters of the universe are so hubristic in their confidence and deluded in their academia-infused understanding of their models and the world, and the models don't work. And that'll definitely be great for gold and silver.
Were we
certainly will
going to
be.
talk about the bullion market?
Yeah, we can talk a little bit about the bullion market, what we're seeing here in the U.S. It's been interesting over the past, well, really probably a couple of months, and I personally think it began with Trump's election. U.S. sales of gold and silver, retail sales of bullion and gold and silver have gone down quite a bit. At the same time as physical metal sales in London and especially in Asia are off the charts, and we've discussed that repeatedly. How whether it's U.S. gold exports or Switzerland imports or the numbers going into China bear that out. But on the U.S. side here, and retail demand has been pretty subdued here. The U.S. Mint only sold 350,000 silver eagles this week. Only 5,500 gold eagles. They didn't sell any fractional half-ounce or 10th-ounce gold eagles, and that's not due to not making any coins. That's due to lack of demand from the APs, that they have plenty of coins and they haven't moved enough to need to replenish their inventory. And I mean, further looking in silver, the America the Beautiful, and the last coin, and partly might be related to design a little bit, but I think overall it's mostly related to the current market forces. The effigy mound, the last ATB released, was the lowest mintage of the entire, what's this going on the 7th year of the ATB series. Only 19,700 coins been minted, versus a year ago, a couple of the first releases were around 100,000 coins. So that's down, about 70-80% year over year for that coin. And again, the effigy mounds, I personally don't think it's the best design in the entire series, but I think overall the bigger part has to do with the retail market. And I think it has to do with sentiment from Trump, and also what we've experienced in the gold and silver market. Prices are now well off their recent lows, and yet sentiment, psychology-wise, the markets don't quite yet give you the sense that they're getting away from you. And what I mean by that is the markets don't quite yet, they're not quite yet causing a retail investor to be greedy and feel like it's getting away, they need to buy now. And I think that certainly could come not too far down the road. Certainly, I think if and when gold makes it back above 1,300 and starts moving higher, and I think you're looking at about $20 or $21 silver, which I personally think we're likely to see this summer. And if we do, I think you'll see physical demand on the U.S. retail market come roaring back. And just wanted to share one anecdote, which is rather interesting, because, I mean, right now, the physical market for silver in the U.S. is probably the softest it's been since the 2008 financial crisis. I mean, we've had customers at SD Bullion calling us and telling us some of the largest guys in the industry are calling their VIP customers up and offering them dealer pricing, even though they're not dealers. They're just desperate to move inventory. Everybody seems like almost giving away deals and coins. And yet at the same time, this week we have a customer who's interested in about 50 to 60,000 ounces of silver and 100-ounce silver bars. And you're looking at a month out to fulfill that order for somebody who wants one product, one Sunshine Mint product of Sunshine 100-ounce silver bars, because even though everybody's swimming in inventory, one order for 100-ounce generic silver bars of 50,000 ounces, 500 pieces, the system doesn't have that. And it'd be 4 weeks to fabricate and produce that. So I think it's an interesting anecdote of, during a period right now, which I think is temporary, the softest period of demand and the most supply that's been available on the market in about a decade, just one guy with $1 million. We're not talking $1 billion. We're talking $1 million wanting to put that into physical silver, and he's going to have to wait 4 weeks to buy a 100-ounce bar product. I think that's fascinating.
Hey, I did my part. I took delivery of some silver eagles from Silver Doctors this week.
He's your biggest customer, Doc.
Yeah.
No, I was probably one of the smaller ones.
You didn't take down 50,000 ounces?
No, that wasn't me. I'm sad to say.
Do those pallet jacks work up in that thin mountain air?
If I had $1 million to put into bullion right now, I'd probably buy gold.
Yeah.
Just because it's easier to hide, right?
Yeah, when you're talking about 50,000 ounces of silver, you gotta have somewhere to put that.
Right. I live in an apartment in the city.
That'd be a good problem to have, though, right, Dave?
It would be a great problem to have.
All right. Any other things we want to talk about with the listeners before we wrap up the show here, guys?
Yeah, I think that's a pretty good place to wrap up.
I got just one comment, and that is, again, and Doc, you had espoused this, I don't know, maybe last summer or maybe in the fall, and if you got money to put to work in the precious metals market, I wouldn't sit around and wait for the market to get spanked. I mean, it might get hit, it might not. I mean, I think we've given enough reasons on why the market has bottomed for now, and if it goes a little bit lower, it's only going to be short-term and, on a temporary basis. It's ultimately heading higher. And the time you want to be accumulating this stuff is when the premiums are low. I mean, the retail psychology is to chase this stuff when the premiums start going bonkers. Well, and everyone else wants in. Well, to be honest with you, I'd rather buy a little more than I intend to now and sell some out when it gets like that. Now's the time to be stacking this stuff. Not when all of a sudden there's another gold rush, which is inevitable.
Yeah, the time to buy insurance is before the fire happens, not when the fire's raging and it's in process and you call up Nationwide.
That's right.
Oh, by the way, can I buy some house insurance real quick? Well, sure, that's going to cost you, though, if your house is blazing.
Exactly.
All right. Well, Dave, we always appreciate your time and joining us back on the show. It's always a good time in the show when you join us.
I appreciate that. And I'll come on anytime you want me to.
All right. You can find his regular work and the Short Sellers. It's the Short Sellers Journal. Is that right?
Short Sellers Journal and the Mining Stock Journal.
Both of those can be found at Investment Research Dynamics. So highly recommend you check that out. So for the Doc, Eric Dubin, and Dave Kranzler, thanks for tuning into this week's SD Weekly Metals and Markets.